In May 2021, Dogecoin's price crossed 70 cents and reached a valuation of $93 billion, but that didn't last long. In the next few months, its valuation dropped to just $27 billion. At the time of this video, $66 billion of wealth was wiped out. The reason why the Dogecoin kept rising, first to $50 billion, then to 70, and eventually to over $90 billion, is that, on the other side of the equation, there were people who paid that much money to buy the Dogecoin. At the end of the day, what drives the price of any asset is demand and supply. Enthusiasts believe that Dogecoin will still rise in value and it has a future. Even if it doesn't, it's still not bad for a coin that started as a joke, but that's normal in the world of investing. Especially in crypto, you never know for sure what will rise and what won't. So we all make mistakes, even the world's greatest investors. In 1993, Buffett bought a shoe company called Dexter Shoes. Buffett's investment in Dexter Shoes turned into a disaster because he saw a durable competitive advantage in Dexter that quickly disappeared. Buffett claimed that this investment was the worst he has ever made. He lost $3.5 billion on that deal. That's why here in this video I want to share with you my 5 worst investing mistakes. In fact, I see a lot of people repeating these mistakes even though they have been in the stock market for some time already. In my over 7 years of experience in the stock market, here are the 5 investing mistakes you should avoid at all costs if you want to stop losing money and start making money. Hello viewers, Steven here, and I welcome you to this channel where we talk about investing, business, and finance. If you are new here, welcome, and why not hit that subscribe button and join our community. And as always guys, give this video a thumbs up for that YouTube algorithm. Now, let's get into it. But before we do that, here is a little disclaimer. This is not financial advice, and everything that is said in this video is for educational and entertainment purposes. Now let's start with the first one. Listening to the big guys. When I got into the stock market for the first time as a beginner, I started reading what the big guys are saying, such as JP Morgan, Citigroup, or Wall Street. In general, I thought that since these guys have been in the market for such a long time, they certainly know better than me. They're professional investors, they have thousands of analysts and economists working for them, so if they're saying that this is a safe investment, then they're probably right. But the truth is, you should never trust these guys because they're saying that because it's in their best interest, and it might not represent the reality. In 2004, when the housing market was turning into a bubble, the dean of the Columbian Business School, Glenn Hubbard, was paid to co-author a paper with William Dudley, Goldman Sachs' chief economist, where they praised derivatives. The derivative market has improved the allocation of capital and risk and was enhancing financial stability. When in reality it was clear that derivatives were creating this bubble that sooner or later will burst. Warren Buffett warned everyone that derivatives are financial weapons of mass destruction, but that's just one out of many examples. Others were paid to say that Iceland's economy is so stable that its housing markets will forever keep rising, but it was one of the first countries to go bankrupt during the 2008 crash. Many people based their investment decisions based on what these economists and professionals said. Others went so far that the top 5 Lehman Brothers executive destroyed their company just to fill their pockets. They made over $1 billion. Do you really think they care about you? So when you want to invest, you have to understand the market yourself. Never rely on authority. Never rely on what the professionals are saying. Of course, always read their opinions, but at the end of the day, make your decision based on your best understanding of the market. Number 2. Not understanding how the market works. The stock market is already slightly complicated, but most people can figure out how it works in a relatively short time. But what most beginners don't understand is how much leverage is involved and how it can impact a particular asset. When you see the news such as traders using 100-to-1 ratio when trading Bitcoin, most beginners don't really pay attention to such news, but if you don't understand that, you should not invest in the first place. Even if you do your analysis, figure out that this asset is going to double or triple. Leverage can destroy everything. The leverage ratio of 100-to-1 means traders are borrowing $99,000 for every $1,000 they put themselves. To say I'm a trader and I have just $1,000, if I make a 10% profit, that's $100, but if I borrow $99,000, now I'm trading with $100,000. And even if I make a 10% profit now, that's $10,000 instead of $100. As always, the more profits you can make, the riskier the assets, but if the Bitcoin price drops by 10, which is quite normal for unstable assets such as crypto, your broker will immediately sell all of your positions in order to minimize losses. In fact, he will sell them at the lowest possible price to exit your position as soon as possible because you have no money left to trade, and if the broker won't able to get his $99,000 back, you will owe your broker the remaining amount plus interest. But the question is, how is that going to impact you if a single trader goes bankrupt? That's not a big deal, but when leverage is widely used in the market, then there will be an oversupply of that asset in the market, even if the price slightly drops. When the supply outweighs the demand, that will further decrease the price, which will push more brokers to exit the positions of their clients. It's like a snowball effect. Suddenly an asset with a promising technology suddenly goes to zero. But some of you might say, if it's a profitable asset, there will always be a demand for it, or there are limited numbers of Bitcoin in the market, so there will always be a demand, unlike fiat currency. There is a promising technology behind it, which is true, but people said the same thing about the housing markets. House is the type of asset that you can touch, feel, and use. In fact, there will always be a demand for shelter. It's one of the oldest and most mature markets in history. And yet leverage destroyed it. So before you invest in any asset, find out how much leverage is involved. Number 3. Not seeing the big picture. When you throw your hard-earned money into the stock market, your heart starts beating twice faster when you see the stock price drop. The fact is, daily ups and downs do not matter at all. They don't even represent how the business is performing on daily basis. A single rumor can dip the price or raise it. That's how the market works. It moves based on people's perception of the company and its potential future. But as a long-term investor, you should not care about that. Check Tesla, for example. It had moments when the stock price dropped by 20, 30, or even 50, but if you take a look at the chart, the stock has increased by almost 18,000% since it went public. The people who saw the big picture understood Tesla's vision and ignored these dips and kept holding their stocks. Tesla is just one out of many examples. There are millions of other examples. Amazon has grown by 192,000% since it went public. So before you invest in any company, figure out its strategy and find out where it would be in 5, 10, or 15 years, and then invest. Number 4. Not investing in knowledge. Most people overestimate themselves. They watch a video or two on YouTube or read a few blog posts on the internet and imagine themselves investing experts, explaining why the Dogecoin is more valuable than the US dollar and that people like Warren Buffett are losers since they haven't invested in the Dogecoin yet. A wise man once said, the more you learn, the more you find out you don't know. If everything was black and white, then everyone would have earned a fortune from the stock market. But the reality is, most retail investors lose, and even hedge funds who charge astronomical fees trying to beat the market often don't. In fact, Warren Buffett bet $1 million that stashing money in an index fund would make you richer than if you entrusted it with a hedge fund manager who spent a fortune trying to beat the market, and guess what? He won the bet. The information you consume on YouTube or the internet is usually made for entertainment purposes because that's how you get the views. It doesn't worth spending so much time and money creating a video when not enough people watch it. So be careful what to trust and what don't. Find credible people, people whom you can trust and who seem experienced. Don't hesitate to spend some money on professional courses. Just a disclaimer, I don't mean fake courses that will teach you how to become a millionaire in 6 to 7 steps. But rather the ones that actually teach you how the market works, how to analyze companies, how to read financial statements, and so on. Remember, time is your most valuable resource, so don't hesitate to spend on education and save yourself a lifetime. Number 5. Not having a clear plan. Everyone gets into the stock market for one reason, to make money. That's the obvious reason, but what most people don't determine is what is their end goal, what is their investment strategy. For example, if you hold index fund stocks, then you should not even follow the stock market. Your goal is to build wealth over a long period, but if your strategy is to pick the right company that will dominate a certain sector, then you should take a completely different approach to investing. And focus on entirely different factors when you do not have that plan. Before jumping into investing, you tend to make all kinds of mistakes. You start reacting emotionally to ups and downs, and you make decisions that will damage your portfolio overall. That's why when you're starting, start with a small amount. Don't put all of your money into any asset, even index funds. Once you try a few stocks, you will have a sense of how everything works and start slowly building your strategy. Otherwise, you will be distracted by all kinds of meme stocks that will drain your bank account and you won't gain much at the end of the day. By the way, what is the worst investing mistake you have ever made? Let me know in the comments section below. Thanks for your time, and don't forget to subscribe and like the video for more content like this one. Bye for now.